What if the company you trusted with your retirement savings, your pension, your life's work, never actually had the money it claimed to have? Not because of bad investments, not because of a market crash, but because someone simply made the numbers up. And what if that someone was sitting in the chairman's office, personally signing off on financial statements that described a reality that did not exist? That is not a hypothetical. That happened. And it happened at one of the most celebrated technology companies in the world, in front of thousands of trained eyes, for nearly a decade, before a single person caught on. This is the story of Satyam Computer Services, a company that fooled auditors, regulators, institutional investors, and board members across multiple continents. This is the story of Ramalinga Raju, a man who built a genuine technology empire and then quietly hollowed it out from the inside, replacing real cash with invented numbers, until the day the numbers became too large to carry and the entire structure collapsed in a single confession letter that shook global markets. To understand how this fraud worked, you need to understand how Satyam was built. Ramalinga Raju founded Satyam Computer Services in 1987 in Hyderabad, India. The name Satyam comes from the Sanskrit word for truth. That irony would become one of the defining footnotes of Indian corporate history. In its early years, Satyam was a legitimate and growing technology services firm, riding the same wave of outsourcing growth that made companies like Infosys and Wipro into global names. By the late 1990s and into the 2000s, Satyam had real clients, real contracts, and real revenue. It was listed on the New York Stock Exchange and the Bombay Stock Exchange. It had offices across the world. It was awarded the Golden Peacock Award for Corporate Governance in 2008, which, given what was happening behind closed doors, is one of the most staggering details in this entire story. The fraud did not begin with a single dramatic decision. That is rarely how these things work. According to Raju's own confession, the manipulation started small, with minor adjustments to reported numbers meant to meet quarterly earnings expectations. This is a pattern that appears in nearly every major accounting fraud in history. The pressure to deliver consistent growth pushes management to smooth out the rough edges of real financial performance. A small inflation of revenue here, an adjusted profit margin there. Each individual decision feels manageable, even reversible. The person making it tells themselves this is temporary, that the underlying business will eventually catch up to the numbers. It never does. Instead, the inflated numbers become the baseline. Next quarter, you have to inflate again just to show growth over the inflated figures from last quarter. The gap between the real company and the fictional version of the company widens every single reporting period. What started as rounding errors becomes systematic fabrication. And at Satyam, the fabrication went all the way down to the bank statements themselves. This is the part that financial professionals still find difficult to fully absorb. Raju and a small circle of insiders did not just manipulate high-level revenue figures. They created entirely fictitious bank account balances. They generated forged letters from banks like HDFC and Citibank showing cash and deposits that did not exist. By the time the fraud unraveled, the gap between reported cash and actual cash on the balance sheet was approximately 50 billion Indian rupees. That is roughly $1 billion, simply invented. To sustain this, the company maintained 6,000 fictitious employee records. These were ghost employees, names on the payroll who did not exist, each drawing a salary that was actually being siphoned out of the business. When you run the math, 6,000 fake employees receiving monthly salaries adds up to a substantial and continuous cash drain that simultaneously provided a mechanism to move money and helped explain why. Certain cost figures on the financials looked consistent. The real employee base was estimated at around 40,000 people. Those were real workers, real engineers, real project managers, many of them with significant tenure at the company, who had absolutely no idea their employer was running a parallel fictional version of itself. Now here is the question that every serious person asks when they study this case. Where were the auditors? Satyam's external auditor was PricewaterhouseCoopers, one of the Big Four global accounting firms, a name that carries enormous institutional weight. Their job was to independently verify the financial statements. Their job was to confirm that those bank balances were real. In a standard audit process, This involves sending confirmation requests directly to the banks, receiving written responses, and verifying that the cash actually exists. It is one of the most fundamental procedures in the entire auditing playbook. The Indian arm of PricewaterhouseCoopers signed off on Satyam's accounts for years. The Securities and Exchange Board of India later found that the auditors had failed to independently verify the bank balances with the actual banks, instead relying on documentation provided by Satyam management. In other words, they asked the company to confirm its own cash, and the company handed them forged confirmations, and those confirmations were accepted. The Securities and Exchange Board of India eventually fined PricewaterhouseCoopers and two of its partners for their failure. The firm paid a settlement. The reputational damage was substantial. But the deeper lesson here is structural. An audit process that relies heavily on documentation sourced through management rather than independently verified is not an audit in any meaningful sense. It is a paperwork exercise. And Raju knew that. He built the fraud around exactly that vulnerability. The board of directors presents a similarly troubling picture. Satyam's board included respected academics, former government officials, and experienced corporate figures. These were not uninformed people. But board members in most corporate structures are inherently limited in their access to operational detail. They receive curated information from management. They rely on the auditors to serve as the independent check. When the auditors are not truly independent, when they are not performing the verification they are supposed to perform, the board is effectively flying blind. In December 2008, just weeks before the final collapse, the board approved a proposal by Raju to acquire two companies, Matas Infrastructure and Matas Properties, for $1.6 billion. Matas, you may notice, is Satyam spelled backward. Both companies were controlled by the Raju family. The market reaction to this announcement was immediate and severe. Institutional investors erupted. Satyam's stock fell nearly 55% in a single trading session. The board reversed the decision within hours. But look at what that near acquisition tells you about how Raju was thinking by late 2008. The fraudulent cash existed only on paper. In reality, money had been flowing out of Satyam for years into Raju family real estate and infrastructure ventures. The Matas acquisition would have, in theory, transferred the real estate back onto Satyam's books at an inflated valuation, effectively covering the hole in the balance sheet. It was an attempt to use a public company transaction to retroactively legitimize years of asset diversion. It failed the moment investors reacted. And that failure left Raju with no remaining options. On January 7, 2009, Ramalinga Raju sent a letter to the Board of Directors and to the Securities and Exchange Board of India. He confessed. He confessed to fabricating cash balances, to inflating profits, to creating fictitious employees, to years of systematic deception. He described the experience of managing the fraud as like riding a tiger, not knowing how to get off without being eaten. He resigned as chairman. He was arrested 2 days later. The markets reacted as you would expect. Satyam's stock collapsed by around 78% on January 7 alone. Investors who had held the stock through its celebrated years, pension funds, retail investors, employees who held stock options, were left holding positions that had been constructed on false premises from the beginning. The total value destruction ran into billions of dollars. What happened next was one of the more remarkable corporate rescues in recent financial history. The Indian government, recognizing that Satyam's collapse would immediately affect tens of thousands of employees and hundreds of client relationships across the world, moved quickly. A new board was appointed. A sale process was launched. In April 2009, just months after the confession, Tech Mahindra acquired a controlling stake in Satyam for approximately $1.13 billion. Satyam was eventually rebranded as Mahindra Satyam and later merged with Tech Mahindra. Most employees kept their jobs. Most clients were retained. Raju was convicted in 2015 along with his brother and several others. He received a 7-year prison sentence. The proceedings took years, involved multiple courts, and saw various legal maneuvers that at points delayed the process significantly. He was released on bail during appeals, and the case continued through the Indian judicial system for years. The regulatory aftermath reshaped Indian corporate governance in meaningful ways. The Companies Act of 2013 included significant new provisions around auditor independence, board accountability, and related party transactions. Regulators tightened the rules specifically because Satyam had demonstrated precisely how those rules could be gained. But the deeper lesson, the one that applies well beyond India, well beyond technology companies, well beyond any particular regulatory framework, is about the architecture of trust in financial markets. Every investor who bought Satyam stock was relying on a chain of independent verification. The company reports the numbers. The auditors independently confirm those numbers. The board oversees the process. Regulators provide external oversight. When one link in that chain is broken, the entire structure is vulnerable. When multiple links fail simultaneously, the result is exactly what happened at Satyam. A billion-dollar fiction runs for years in plain sight. Raju later claimed in interviews that he had genuinely hoped the business would grow enough to close the gap. He talked about the pressure of being a public company, the expectations of investors, the fear of what disclosure would do to the thousands of people who worked for him. These are the kinds of rationalizations that every major fraud perpetrator eventually offers. They are not entirely without psychological coherence, which is what makes them dangerous. The road from small misrepresentation to catastrophic fraud is paved with exactly that kind of reasoning. The name of the company, as noted, meant truth. The financial statements, for years, said something else entirely. And the entire machinery of institutional verification, the auditors, the board, the regulators, the analysts, watched it all and called it credible. That is the real story of Satyam. Not just that one man lied, but that an entire system was designed in a way that allowed the lie to breathe, to grow, and to compound, until it became too large to sustain and too expensive to hide. Every investor, every employee, every institution that believed in that balance sheet was trusting a document that someone had typed from imagination. And nobody checked. If you want the full story and more dark business secrets, find us on YouTube at Corporate Crypt. The link is in the description. Subscribe so you never miss a story. And if you want to create content like this yourself, check out the AI tools in the description below.